Welcome, everyone, and thanks for joining us here. I'm Gerry O'Shea, the head of global content at Hashdex. And for those of you unfamiliar with Hashdex, we are a global crypto asset manager with investment products throughout Europe, Latin America, and the US. And our mission is to connect investors to the crypto economy through high quality education and simple and secure investment products that provide regulated access to the emerging crypto ecosystem. So as part of our mission to educate, we do webinars like this, and we're fortunate today to be joined by one of our partners, Nasdaq. And the theme of the discussion today is around diversification. So the potential benefits around broadening exposure to crypto assets. Obviously, diversification is a time-tested investment strategy, but we're here to really answer the question today, does it work for an emerging asset class like crypto? So our guests here are Sean Wasserman, who is Nasdaq's Vice President and Global Head of Index and Advisor Solutions, as well as Samir Kerbage, the Chief Product and Technology Officer at Hashdex. So before we get started, there are two very quick administrative notes. First, we will have time at the end of this discussion for Q&A. We're going to save hopefully about 20 minutes or so at the end. So please include your questions in the Q&A section, and we'll hopefully be able to get to all of them before the end of the hour. The second administrative thing is that definitely have to read a disclaimer here. So I'll be quick and say that this webcast is for informational purposes only, and nothing should be considered the official opinion of Hashdex or Nasdaq. This presentation is not an offer to buy or sell, nor is it a solicitation of an offer to buy or sell. Certain information contained herein constitutes forward-looking statements. Due to various risks and uncertainties, actual events or results and the performance of the products may be substantially different from those reflected or contemplated in such forward-looking statements. As a result, investors should not rely on such forward-looking statements should there be making their investment decisions. For any product-specific information, please refer to the appropriate prospectus. All right, so let's go ahead and get started here to talk about diversification here. The first question I'll throw out to Sean. You know, Hashdex has partnered with Nasdaq in both creating the Nasdaq Crypto Index and also on the Digital Asset Academy and educational tool for advisors. Can you talk a little bit about how this partnership came together and kind of lay the groundwork for our discussion here about the index?
Sure, happy to. I'm glad to be here, Gerry and Samir. I always enjoy doing these sessions, particularly looking back on how far we've come with the organizations and the journey that we've taken as an index business and digital assets. Because kind of rewinding back, I believe it was in some point in 2019. Like I've always been in the index business, been at Nasdaq for about 10 years now, and always have a focus on designing and bringing to market indexes that would provide some sort of unique solution or help investors to access some part of the market that they're having challenge to today. And started out meeting this firm Hashdex that was a crypto asset manager at the time. Really didn't know much at all about the crypto asset space, about Bitcoin, and really sort of started to have kind of my eyes open in terms of kind of what is kind of the revolutionary aspect of this underlying technology of blockchain. Getting intrigued to really start to kind of learn more. Like at the time, Nasdaq has done a variety of things in the digital asset space coming up to that time, predominantly on the market technology side. Providing our matching engine to a variety of crypto exchanges, powering markets, along with our surveillance technology, helping them to kind of monitor the trading that's going on in those. But haven't made the foray for the wider business, particularly for indexes. And so started to look at the landscape and to understand kind of what services are out there, what indexes are available, what investment products, and was really seeing kind of a lack of what we would deem more of like an institutionally investable version of beta that we felt that we could, with the proper due diligence and research, come up with a benchmark that would help serve those needs. In terms of looking at the landscape, very much, for most part, people look at Bitcoin at the time, maybe a little bit of Ether, and thinking about that as, what is crypto? But we felt that, for the long term, as like investors would consider, investing in the space, it ties back to our overall index business and being able to provide an index that is representative, dynamic to, adjust with the market conditions, actually represent what is available in the marketplace. And we felt like that was relatively lacking in the space, and hence coming together with the team at Hashdex to kind of design an index that would ultimately meet those needs. We are very much, I guess you could say, philosophically aligned in terms of how we thought about the space, in terms of designing an index and being dynamic to represent how it's changing in the landscape, but also being institutionally investable. So we've launched the index back in February 2021. So, we're about a year and a half in, and it's been very interesting to see in terms of the changing landscape of the index itself, of the assets, that we've added, and continuing to engage with the overall, community that we provide due diligence on in terms of the exchanges and custodians that we have as part of our methodology. And we could get into a little bit later. I know Gerry mentioned the academy, but that's certainly another aspect that we've been, quite pleased with the efforts we've been having in terms of developing holistic education for the space.
That's great. That's very helpful context, I think, for this discussion. And I think you mentioned the methodology, and in my opinion, that's something that certainly sets the index apart from some others out there. Could you talk a little bit about the methodology, why it's appropriate for professional investors, and maybe even how it's different from some of the other types of indices that are out there?
Sure. So, there's a few unique aspects of crypto that require us to take a step back and understand kind of what is the overall infrastructure that is supporting this space, and how do we develop a methodology that is kind of analyzing that infrastructure and only representing the assets that are kind of truly being supported by that, but it can be dynamic in nature over time, so that you're not re-engineering the index to kind of capture the changes in the market. We felt we've created what you will call, I guess, more of like a future-proof type of design to be able to capture the changing landscape. And when I speak of that, it kind of, I mentioned a little bit before, it comes down to like two things that we have in our methodology. It's called the core exchanges and core custodians. The exchange side, when you think about creating an index, it's very important that you have accurate pricing to be able to trust the pricing that you're seeing for the individual assets, to reflect that as an index price. That was one of the big things that we wanted to make sure here at Nasdaq, that we could have a robust process and a due diligence process of exchanges, so that we are comfortable with the environment in which those crypto assets are being exchanged. And then, as I said, in turn, being able to use those prices to reflect the price in an index. So that's where we developed like a number of things in terms of working across our organization, across legal and risk and trading and market surveillance, in terms of what are the types of things that we would look for in a market, to be able to, as engage them in that due diligence process, looking at things such as being able to work with the relevant regulators that they need to be working with, that they would have proper AML, KYC controls in terms of the assets that they're onboarding, that they would have capacity, in terms of kind of how they're managing that capacity in trading, so that they could handle those, so proper IT, like infrastructure. And so with that, we started out and basically ended up with 5 exchanges that met our vetting criteria: Coinbase, Kraken, Bitstamp, and Gemini. From there, there's also the custodial aspect, and this was a big thing that really helped us get towards the comfort of providing an index, is what we'll call institutional level custody. So the advent of custodial solutions that would be available to asset managers and institutional investors to kind of safeguard those assets. Looking at things in terms of the overall, particularly the IT infrastructure, that they would have, that these custodians would have, segregated accounts, for the managers and their clients, that they would have proper insurance policies. These things didn't used to be in place in the industry. And so these are, we felt like, were the two core tenets that were needed to be able to identify kind of which assets we will be comfortable putting into an index. And so that's where, the methodology is the way we have it designed today, is that an asset has to be supported by a minimum of 2 exchanges in terms of pricing inputs. And we have that with the US dollar pair in terms of, their trading, along with supported by at least 1 custodian. So we start out by looking at the overall landscape of hundreds of assets, and to whittle down to which ones are supported by that institutional level infrastructure, but then also looking at which ones are, say, have the minimum size criteria that we're looking for. We're essentially looking for at least a 50 basis point position in order to enter the index. And also minimum liquidity in terms of looking at their dollar traded volume on the exchanges that we're looking at, so that we're setting a minimum bar and we're capturing the assets that are meeting that minimum threshold. At the same time, we feel like that construction is designed so that as we're continuing to evaluate new exchanges and new custodians and re-engage them on an annual basis to make sure that they're continuing to meet those criteria, or different assets kind of rise in the ranks in terms of their size and liquidity, that we're naturally capturing those as part of our quarterly reconstitution process. But the other aspect we felt like that was also really important to add, where we add a unique nature here at Nasdaq, is kind of a final check on the portfolio. So we run that standard objective criteria, but then we also have a committee that is drawn on the expertise across the wider groups within Nasdaq, to be able to look at the different assets that are then eligible to be added to the index, but then having the ability to exclude an asset if we were to deem it to say, being deemed a high risk of being deemed a security, here in the US, or some other form of, reputational risk. We're looking to make sure that as we're kind of having those assets that we do, it is important to have kind of a final check, not from an active standpoint. It is very much, we want to make sure that we're being objective and constructing it as an index. But there is, given the landscape and the different things that occur within the crypto landscape, that we do at least have a final kind of due diligence screen to kind of screen out things that we may not have that comfort level on. And so the other thing really to add in terms of, you mentioned those differentiating points that kind of come as part of construction, is really just no minimum or maximum number of assets. The index is 11 assets today, but 2 years from now it could be 30. It all really depends on kind of the evolution of the asset class. And the other is not capping, where we feel that we're representing basically an index similar to the equity world, we would call free float, we would call supply weighted, to be able to represent what is actually the size of in the adoption of these assets in the asset class, and having that be representative of beta. We felt like no index really effectively had done that in the marketplace, and that kind of comes back to really what we looked at as the core tenets as to how we constructed the index.
That's great. Thanks, Sean. I think with that, Samir, as kind of a backdrop, maybe we can turn to the core question of this webinar, and why diversification may or may not work with crypto assets. And I think if I'm an investor and I see that obviously Bitcoin, because of the size of it relative to other crypto assets, is a huge component of the index, why not just invest in Bitcoin or maybe Ethereum? Why go beyond those two large assets to invest in more crypto assets? Can you talk a little bit about the kind of investment for broadening your exposure?
Oh, sure. And this is a very important question, and we actually get this question a lot from especially like professional investors, because if you look at the current constitution of the index, you see that it's basically 60% Bitcoin, 30% Ether. So why not just buy Bitcoin, or buy like Bitcoin and Ether individually? So that's a very important question, a very critical question. And there's like 3 points I'd like to highlight on this. The first is that crypto is a nascent asset class. It's too early to call the winners. So like if we can say it right now that the NCI is 90% Bitcoin and Ether, 2 years ago, 2.5 years ago, it was 90% only Bitcoin and some 5% Ether and other assets. So this ecosystem is changing that drastically and will change a lot in the next few years. So if you look in the landscape of the next 3 to 5 years, we expect this ecosystem to change a lot. It's too early to call the winners. It's too early to say that Bitcoin will be the only crypto asset or Ether will be the only smart contract platform. We have a bunch of new applications coming up on top of this smart contract platform. So it's really a nascent asset class. It is too early to do individual allocations to the assets and expect to capture the value of this whole asset class. And that comes to the second point, which is like the way we believe that the investment approach should be done in crypto. So investors that have like a traditional portfolio and have a long-term view should see a crypto allocation as a strategic allocation, not only a speculation, short-term speculation, but a long-term strategic allocation in a nascent asset class that can transform our society profoundly in the next few years, but also has a lot of risks. So when you consider crypto as a strategic allocation in your portfolio, it's very important that first, like the time horizon of that allocation should be long-term. So you should look for investment strategy that could capture the value creation of this theme, this topic in the long term. Not only right now, what we see now in the like 6 months, but what is the outlook for the next 5 to 10 years. The second is that it's important to have a small allocation. It's a high volatile asset class, so it can change a lot. It can benefit your portfolio, increase the risk-adjusted returns of your portfolio, but also the difference between I would say the poison and the medicine is the size of the dose, right? So it needs to be a small allocation. So in a small allocation, like, is it better to just concentrate on Bitcoin or try a diversified approach? Which comes to my third point, which is the diversification. Diversification is a time-tested investment approach. It works with most asset classes. It's very hard in the long term to consistently beat a passive investment strategy, a diversified and passive investment strategy. And especially in crypto, such a nascent asset class with so many different investment theses, right? So Bitcoin, it's a dominant asset today, but its investment thesis is completely different than Ethereum, and it's completely different than DeFi. So we have at least, I'll say 5 investment theses around crypto. You have the digital store of value, the emerging digital store of value that Bitcoin is currently proposing. It's a long-term investment thesis. Bitcoin is not a good store of value right now at the current phase, but investment thesis that it can become a relevant store of value in the future. That's the opportunity, and that's also the risk. You have the smart contract platforms as the base of a digital native economy, right? So with Ethereum, Avalanche, Solana, Polkadot, there's different assets there. Too early again to call the winner. We don't know how the future is going to look like. If it's going to be a market where the winner will take most of the economic value, and in that case, Ether may be the winner, or it can be like a very rich, diverse ecosystem where we could have 1, 2, or 3 dominant smart contract platforms. So it's too early to call that. So it's too early to do a directional approach investment on Ethereum specifically to capture the value creation of the smart contract platforms. And then on top of the smart contract platforms, you have at least 3 verticals. You have the Web 3.0 movement, which is like the new version of the internet, of the web as we know it, a decentralized one where we have the concept of digital property, where you can own your data and own your property, own your assets, and not just having like companies owning this and using this to their advantage. You have the decentralized finance movement, which is currently in an experimental phase, has shown its robustness during this last liquidity crisis we saw, and can be in the future, in the next 5, 10, or 15 years, can be the backbone or the back office of the financial system as we know. So it has a very transformative investment thesis. And then you have the digital culture NFT movement, which is basically the digital transformation of our society taken to our social interactions. So you see, there's at least 5 different investment theses, very diverse. And it's too early to call the winners on those different strategies, different theses. Too early to say how those theses will unfold in the next few years. So that's why we believe that for long-term investors that are looking for strategic allocation in crypto, which is the way we see this right now, as the best way to capture the value creation that crypto will bring in the next few years, a diversified approach and a passive approach like the one we designed for the NCI is the best for most of the investors.
And I think one of the things that you touched upon, Samir, was, crypto, it really is arguably the world's first truly global asset class. And I think, with that, certainly there come challenges in terms of the different regulatory environments and things like that. And this next question, I think I'll ask Sean, in terms of as we, firms like Hashdex want to provide products in different regions of the world, how are you all, Sean, kind of looking at offerings, index offerings, and kind of changing methodologies to meet requirements in different countries and regions? Can you speak about that a bit?
Sure, and it's a fair question that we've just started with in terms of the expansion to Europe, and I would anticipate us having more and more conversations over time as the regulatory landscape changes in different areas of the world and different product opportunities open up. But we went through that exercise, particularly in Europe, not too long ago, where we had launched the Nasdaq Crypto Index Europe, back in May. And very much, follows the same tenets in terms of the overall approach that we talked about of, minimum size, liquidity, core custodians, core exchanges, but really looking to understand the nuanced differences of the local regulatory environment in terms of, what would be accommodated for, like investment product. So as we were working with the team, the Hashdex team and bringing, ETP product in Europe, they had ambitions towards bringing initially, ETPs on SIX Exchange and Extra in Germany, where they already have established regimes and kind of ETP rules around kind of what is permitted to be listed on those exchanges. So it took the approach of basically custom designing the index, as I said, taking that same kind of core tenets of the approach, but then basically putting an additional screen on the index so that only those assets that are permitted to be listed on those exchanges could be included in the index. While at the same time have a little bit of a different view in terms of some of the screening on the committee side, where the overall NCI index we have is our global flagship, particularly from like a kind of a U.S. regulatory kind of centric view of applying the Howey test of the risk of an asset being deemed a security, which isn't specifically as relevant in terms of kind of the listing standards at some of the European venues. So kind of understanding those kind of nuances and then kind of building that into the index design, hence leading to what we have now is 2 versions. We have the NCI, which is our overall Nasdaq Crypto Index, which we work closely with the Hashdex team in Brazil and the U.S. and Victory Capital in the U.S. in partnership with them. And the Hashdex Europe team in terms of the Nasdaq Crypto Index Europe. And we'll see what other ones we have in the future as we engage in more regions and in territories.
Thanks, Sean. And maybe I'll go back to my last question to Samir and say, okay, so you've convinced me that I need to broaden my crypto exposure beyond Bitcoin, beyond Ethereum, and invest in an index of crypto assets. Like, how is now the right time, or is now the right time to be doing that? We're in a crypto winter. There's a lot of questions out there about crypto in general, and its future. So can you maybe speak a little bit about the current environment and how investors might want to look at this landscape from an investment perspective?
Sure. So we're definitely living in a very challenging macro environment. So we're seeing like big headwinds, not only for crypto, but also for all the risk assets. So we're seeing developed markets facing highest inflation in 40 years, like growth slowing up. We started talking about recession. So it's really like a challenging macro environment. And I think it's a great moment for investors to reflect on their investment strategy in their portfolio construction overall. And for investors that are building a long-term portfolio with investment horizons above 3 to 5 years, it's also an opportunity to allocate smartly in different risk assets. So it's not a time to be just like in a risk off movement and taking off all your risk to the table, because also the bond market or the fixed income market is very challenging. But it's a moment for long-term investors to reconsider their portfolio allocation and their allocation to risk assets. So when we look at crypto specifically, we see that it's suffering a lot from the macro headwinds, of course. It's going down just like the Nasdaq 100, just like most of the tech companies. And it's even like when you see like a beta adjusted projections of the attributions, we're seeing that crypto is even being more penalized in the short term by two events specifically. The first was the collapse of Terra Luna, and the second was the whole liquidity crisis triggered by Celsius and the credit markets in crypto. And those two events are very short-term events. They are liquidity crisis, like fear in the market in terms of like liquidity and waves of liquidations, and they don't really affect the long-term outlook of the investment thesis I was describing previously. So we're seeing like crypto prices even more penalized than technology companies because of short-term events that don't impact the long-term outlook for the marketplace. And then on the fundamental side, we're seeing that the fundamentals are only getting stronger, right? So 2 weeks ago, we had the merge on Ethereum, which is a big, I would say, a landmark or on its evolution and in its roadmap towards a scalable solution. We're seeing, just like in the early 2000s for the internet, we're seeing what we can call now the broadband phase of crypto, right? So if you remember back in the internet phase, there was a big challenge around like scalability. How can we have like this access? We could see the potential of the internet in the late 90s, but was very hard to scale. It was very hard to consume the services, and the society wasn't ready to consume those online services. And with time, what we saw is that the infrastructure evolved. So we saw the broadband phase of the internet that made the internet accessible like to billions of people around the globe. And the society started to get used to that technology. We're seeing this happening now in crypto. So on the infrastructure phase, we're seeing the evolution on scalability solutions, not only on Ethereum, but also we're seeing layer 2 solutions coming up with different approaches for scalability for crypto to go from like a niche use case of like few millions of users to something that eventually billions of users will use every day, right? So we're seeing this in front of our eyes on the fundamental side. On the regulatory side, if we look like 2 years ago when we were like speaking with institutional investors, they were very afraid or conservative about considering a crypto allocation because of the regulatory landscape. So like the US government can ban Bitcoin or Ether anytime, and then like what's going to happen with my portfolio? That will go to zero and that kind of stuff. So what we're seeing in the regulatory space in the last 2 years, especially in the last 6 months of this year, is an evolution. So regulators are looking in crypto in the right way. How can we design a regulation that will protect consumers, that will suppress criminal activity, but will also foster innovation, right? So we're seeing a shift in how the regulators look at this space. So this is also very positive for the next few years. And then so that's why we think for long-term investors, it's very important to consider crypto allocation, and it's very important to consider crypto allocation now that the prices are very depressed. And then on the investment strategy, if the investor is already allocating crypto, but it's only Bitcoin or it's only Ether or Bitcoin and Ether, it should reflect on the diversification aspect of this, like how this asset class can benefit on the recovery side of this macro crisis, how like this asset class will evolve and recover from this. And we believe that diversification is very important. And also on the taxing side. So if you're a tax sensitive investor, maybe it's a good opportunity to use this moment to rebalance or to shift your portfolio to a diversified approach with I would say some tax benefits. It's better to do now than after you need to basically collect the capital gains tax. So it's a good moment to consider diversification.
That's great. And I think maybe I have one more question for you all, and remind the audience to submit any questions you may have, and we'll reserve some time at the end for questions from the viewers. So actually, Samir, this kind of picks up on what you were just talking about in terms of kind of the overall interest in this space. And are there, so you read the kind of popular media when the price is going up on crypto assets, there's a lot of attention around. When we're in a kind of sustained period where prices aren't spiking, there's not so much attention. So sometimes I think it's hard to figure out where the interest is. Is there still kind of institutional interest in this space? Is there still interest from financial advisors? And I know BlackRock had their announcement a few months ago about expanding the Aladdin platform to include crypto assets. So can you share some thoughts on like just interest in general? I mean, it is during this crypto winter, are there institutions and other investors that are still kind of excited about this space, or are they sitting on the sidelines? Thanks.
Oh, sure. We can, like, what we see here, like being an asset manager and having products in different countries, talking with investors on a daily basis, we see that the interest remains. And I think like people understood that crypto is a long-term play. It's not for short-term speculation. So when we see on the retail side, we've seen a strong resilience on retail investors, at least like as we measure from our products. The number of retail investors is only growing. We don't see a big churn in terms of the allocation, which is very surprising because prices are dropping significantly. So we're seeing that like even like the retail investors, they understood that this is a long-term play, that they like should consider the time horizon. Despite the liquidity, you can see the prices moving 24/7. You can get scared, but they understood that this is a long-term play. On the institutional side, what we see, and this is a very positive aspect, is that the institutional interest remains and the curiosity is being triggered, right? So during our conversation with institutional investors, we see that the players that already had allocation to crypto, they keep their allocation and they are considering rebalances. The investors that currently don't have crypto allocations, they are studying the topic. They're following up. We're having like some great conversations, and they're tracking the thesis to see when is the right time to allocate. And when we see like overall institutional interest, we can talk about financial institutions like BlackRock, like big banks, like even Nasdaq with its digital asset strategy. The institutions are coming. They are building the infrastructure. We believe that this next 2 to 3 years will be the time for more traditional institutions to build and deploy their crypto investment or their crypto strategies, which will be very important for the coming years. On the VC side, we've seen a record allocation to the space. So we saw a record allocation in 2021, and in 2022, we are on track to surpass 2021 in terms of the VC capital allocated to crypto. So that's a very positive and surprising considering like the macro environment. But we're seeing like the money still flowing to crypto, talent still flowing to crypto. And if like the big applications or the big investments we saw developing during the 2020 to 2021 bull cycle, they were originated during the 2018 record investment from venture capital in crypto, right? And currently we're seeing like 5 times, 6 times more investment in crypto than we saw in 2018. So we can only be optimistic about like what is to come in the next 2 to 3 years in terms of actual use cases coming up of those out of those investments.
You mentioned the Nasdaq's digital asset work, and I do want to give Sean the opportunity to talk about some of the recent announcements around initiatives that Nasdaq has going on in that space. Sean, if you want to talk about those.
Sure, I have to. Yeah, I saw one of the questions come in, related to that. So thank you. So yeah, as mentioned earlier, we started, like on the market technology side, providing our matching engine and surveillance, branched out into indexes, and really kind of continuing to see over the last few years kind of increased demand across all different types of institutions and organizations of building crypto related services or looking to adopt crypto in some form of fashion. And so we do, in terms of answering the question, we certainly are seeing that demand in terms of kind of building the businesses around it, and also the interest in being able to utilize the assets in different capacities and to store those assets. Hence, kind of the creation of the new unit and kind of getting more directly involved in the space. So we announced a few weeks ago the launch of kind of Nasdaq digital assets. We brought on a senior leader for that group, Ira Arbach, who's kind of leading our efforts. And as mentioned there, kind of the first effort that we really are driving towards for pending regulatory approval and launch in Q1 of next year is a custodial offering. We see that as an area that is also going to be of continued need for institutional investors to have choices to be able to utilize, but also like an opportunity to continue to advance the technology that organizations are using to be able to both safeguard those assets, but also more easily access them. And so that's where we'll be able to continue to be kind of more closely engaged with the community and understanding kind of what their needs are and developing new and better solutions. So we certainly have seen that demand. We anticipate it becoming more and more part of the kind of the overall investing ecosystem, but more of also the societal ecosystem in terms of kind of the use of crypto in different capacities. So yeah, certainly becoming more and more of a focus for us organizationally, hence the launch of the unit.
Thanks, Sean. I think, and we can kind of, that was basically our first audience question. So maybe we'll just continue on with the audience questions at this point. We have another one here. I think, Samir, if you want to comment on this, but the question is, what crypto factors, unrelated to economic or fundamental factors, are currently a headwind for the crypto market?
All right. So in terms of crypto idiosyncratic factors, I would say that first, we're still seeing a cleansing of the last bull cycle. So we know how those new technologies develop. So there's a lot of enthusiasm and a lot of projects that grow out of without, I would say, either a substance in terms of the value proposition or not a good timing. So sometimes it's too early for certain types of solutions. We saw that in the internet bubble, right? So we saw some solutions coming up in 98, 99 that were great ideas, but the infrastructure or the society wasn't ready to consume those types of services, right? So we're still seeing a cleansing on the market. I think the leverage has reduced a lot, and we've seen a big cleanup in the market in the last few months, but we're still seeing a nascent asset class grow. But in terms of challenges I see for the next few years that we need to overcome, there's basically, like I said, two main challenges. And just like any new technology, just like the internet or the personal computer back then, first is infrastructure. So we need to evolve on the infrastructure side. We need to scale. Crypto is currently not ready to scale. It's not ready to have millions of billions of simultaneous users. So we need to scale in order for its investment physics to develop. And the second one is more like the shift, the generational shift in our society. right? So our society needs to adjust, needs to understand how to interact with digital assets. The concept of a digital wallet, which is still like a challenge for most people. The concept of like a fully digital property that we can explore. Even like the regulatory side, I see as a basically a demographic shift or a generational shift. So regulators that are seeing that this thing is not going away, and we need to tackle this. We need to face this. So I put this on the, I would say, on the generational shift, like regulators incorporating this and defining the best practices, and also like the user experience, right? So design and think they're more, they're easier to use for the general investor. So we're still seeing a phase to build. There's a lot of things to build in the coming years to allow crypto, the investment thesis, to develop even further. So I would say those are the major challenges. I don't know if this is a headwind, but it's definitely a challenge we're going to see in the next few months and years, is infrastructure side and the generational shift of our society to adopt the new technology. How long that would take will depend a lot on us. Will depend a lot on the regulators, on the industry participants, to define how long our society will get used to those types of technology.
Thanks, Samir. We've got the next question. It looks like it's for Sean. And Sean, I think you kind of touched upon this earlier, but the question is around the differences between the NCI, the Nasdaq Crypto Index, and then the NCI Europe. Is there a difference in holdings or any other differences that you may want to highlight?
Sure. It really is just some differences in the holdings, which is just more kind of dictated about on the different regulatory environments, between the U.S. and Europe. So where the NCIE, the European version, is specifically looking towards on a screening mechanism, what assets are permitted to be allowed for inclusion within an ETP, where originally it's designed with starting with 6 and extra, and then more recently expanded in terms of Hashdex bringing the products to Paris and Amsterdam via Euronext. So we have that as a specific screening criteria for the wider NCI. One of the things that we have in there from the committee standpoint is screening in terms of, as it relates to the Howey test, in terms of the risk of an asset being deemed a security, which isn't specifically relevant for the markets on which we have the NCIE for ETP listed product. So that's really the main difference. So there are a few assets that we've excluded on the NCI side, where we're applying that Howey test in terms of what would be deemed a high risk, versus on the European side, that's already, they have a specific view in the exchanges there in terms of what they would allow, within a product.
Thanks, Sean. We do have a question about, Samir, a question about DeFi. And I know that, so in the latest NCI Europe rebalance, Uniswap was a new asset that was included within the index. And the question is around kind of the potential for DeFi. So I wonder if maybe could you talk a little bit about the inclusion of Uniswap in the index, what that means for decentralized finance, DeFi protocols, and kind of their investment case?
Sorry. Yeah, no, sure. So Uniswap is one of the most relevant decentralized finance services currently. They're seeing some great tractions in the last few years. So for those who don't know, Uniswap is a decentralized exchange protocol. So it allows people to basically exchange any digital assets that is issued on the Ethereum network without the need of an intermediary. So like you can basically trade any asset using Uniswap, and its traded volume has been growing over the last few years, even surpassing some like big centralized exchanges like Coinbase. And like the fees, the fees are very competitive, and they remain on a healthy stage across this crypto winter, and most importantly across the liquidity crisis we saw between like May and June of this year. So we've seen like a very positive outlook on crypto and on DeFi specifically, because we saw a big liquidity crisis and the DeFi ecosystem was very robust. So it went through a major liquidity crisis. Like if we had this type of liquidation in I would say the more traditional environments, we would need to have like central banks, governments like bailing out financial institutions. And we saw that type of crash in crypto with private participants creating like basically a domino effect in terms of liquidations, and the DeFi ecosystem were very robust. It went very robust during this crisis. So we're very optimistic about the whole DeFi investment thesis. Of course, there's a lot of challenges in the coming years. There's the regulatory challenge. So how the regulators could define rules can protect investors if there's no intermediary, there's no one there offering. It's just like a piece of software running on a blockchain 24/7 without people actually maintaining it. So it's a very challenging aspect for the regulators, and we need to see more regulatory clarity in order for like institutions to adopt DeFi, which is where I see a big opportunity for value creation on the DeFi. DeFi has the potential to be the backbone of the financial system, can be the back office of most of the financial institutions. That will bring a lot of competitive advantages for the financial institutions. So it's a great opportunity, but there's a lot of challenges in the coming years. And I think those challenges, they create the risk, but the payoff, if we can overcome those challenges, it's very relevant. So we're still very positive and think like DeFi is one of the most relevant applications of blockchain technology.
Great. We have just about 7 or 8 minutes left, and there's a couple questions that are kind of asset specific. The first is around Ethereum. How does the success of Ethereum's transition to proof of stake impact its investment value? Are they the only smart contract game in town right now? And that's a question I think for you, Samir. I think you're on mute.
So yeah, I believe this is like the merge, the success of the merge is a very positive development of the investment thesis in Ethereum, because it was a major upgrade. It was very anticipated. People like the developers, the community has been working on it for the last at least 5 years. So it's a major development, and it's it's a prerequisite for some scaling solutions that will be implemented in the coming years. So although it doesn't change much in the short term, of course has changes in the short term, like the consensus mechanism, like the energy consumption, the decentralization of the network, we see that the most relevant impact it has is on the long term, how it allows new scaling solutions or scalability alternatives to emerge for Ethereum. So it definitely, it's very positive. It reinforces Ethereum's leadership in the, I was saying, in the smart contracts race for scalability. So we have different, like other smart contract platforms also trying to reach critical mass in terms of scalability and adoption. So we're almost seeing like a race, which Ethereum is clearly the winner. But it's still too soon, like, to determine if the future is going to be, if this segment will have like a winner takes most dynamic, or if it's going to be a diverse ecosystem with different smart contract platforms for different applications or different use cases or different industry participants. So too early, but like the merge is definitely like a great development, and one that makes us very optimistic about the investment thesis in Ethereum.
Thanks. And it looks like our last question here is also asset specific around Bitcoin. And the question is about Bitcoin being an inflation hedge. If it is supposed to be an inflation hedge, why is it performing as it's performed over the last few months in this inflationary environment. So if you could touch upon that, Samir, that'd be great.
Yeah, no, that's a great question, because we've been getting this question a lot, and I think like mostly because as people refer to Bitcoin in the last few years, they're stating that Bitcoin was an inflation hedge and was a store of value. And there's a difference between like I would say the investment thesis and actually believing on this. What I mean is our investment thesis, and if you see like for investors that we've been discussing for the last few years, they will know, and it's written in our material, our investment thesis for Bitcoin is an emerging digital store of wealth. So it is the first time in our society that we have a digital store of value. So we're still going to understand how to interact with this, how this thing is playing up in terms of its characteristics. It is like in terms of physical aspects of properties, it is very, very compelling or very attractive in terms of its practical use as a store of value, but it's still very nascent. The society still needs to understand how to interact with this type of technology. And if you check right now, the consensus across our society, and especially across traditional institutional investors, is that Bitcoin is not a good store of value. So it doesn't work or doesn't function currently as a store of value, but that's why it's emerging. So we can see like the investment thesis playing out is that I would say in the next 5 to 10 years, as our society gets used to the concept of digital assets, as this generational shift happens, and as the infrastructure evolves, we're going to see our society, most players of our society, institutional investors, seeing Bitcoin as a good store of value. And that is the opportunity, that's the upside, but it's also the risk, right? Currently, it's not a good store of value just because people don't believe in this. So if that changes in the coming years, and we believe this is going to change a lot in the next 5 to 10 years, we're going to see a lot of adoption in Bitcoin, and that can be very positive for its prices. So that's a very important point for investors. Bitcoin is currently not an inflation hedge. It's currently not a good digital like store of value, but it's an emerging store of value. It can show its powers in the next 5 to 10 years, but it's currently our society is not ready to adopt digital store of value in the current state of our digital transformation journey, right? So that's why it's not currently acting as an inflation hedge.
Thanks. And we actually just have one very last question here for Sean that just came in. Sean, can you remind us again for the Nasdaq crypto index? The question is around how often the constituents of the index are reviewed.
Yeah. So once a quarter. So that's where every March 1st, June 1st, September 1st, and December 1st, we have the new basket. That will go effective where around 2 weeks prior, we're announcing kind of what the updated composition will be. So as soon as we're announcing and then going through the reconstitution, like within a few weeks, we're then turning our attention to analyzing the data and any potential new assets, and then evaluating their potential entry. So it's every 3 months, but it's a constant process on our side in terms of kind of staying within that 3-month time frame every quarter.
And that's a very important aspect, because you can capture the evolution of the asset class. So new assets can come in as they gain relevance, and also assets that are not showing traction or they're losing participation, they can be removed from the index. So that's why I think that's one of the characteristics, along with not having a cap or a fixed number of assets, that makes it dynamic and makes like the NCI capture the long-term trend or the value creation on the crypto investment thesis.
Awesome. Well, thanks, Sean and Samir, for the time today. We're just bumping up on the hour right now, so we'll wrap things up. And thanks to everyone for attending. This was a great discussion. And if people want additional information on any of this, feel free to visit our website at hashdex.com. And there's certainly more information on the Nasdaq Crypto Index indices that you can find there as well. So thanks again, guys, and we'll be in touch soon. Take care.